Right now, as we speak, the live trading dashboard is flashing a sobering reality for Beyond Meat Inc., with the stock sitting at exactly 0.98 USD. We are looking at a downward movement of 0.00040 points, or roughly 0.041% for the day so far. But that fractional move hides a much more violent story churning beneath the surface of this equity. When you see a stock that was once the darling of Wall Street, trading at triple digits, now fighting to hold the $1 line to avoid delisting, your instinct is probably to look away or write it off as a failed experiment. That is the expectation most casual observers have, that the plant-based hype cycle has fully collapsed and there is nothing left here but a slow drift towards zero. But the reality of what is happening inside Beyond Meat's boardroom and on its balance sheet right now is far more complex and aggressive than a simple failure narrative suggests. We are not just watching a company fade, we are watching a binary capitalization event unfold in real time, where the outcome is either a total restructuring that wipes out common equity, or a miraculous survival pivot that could trigger one of the most violent short squeezes we have seen since the early days of the meme stock mania. This isn't just about veggie burgers anymore. It is about solvency, debt covenants, and the brutal mathematics of survival in a high-interest rate environment. To understand why this 0.98 USD price point is so critical, we have to look at the immediate context of the trading session. The volume today is telling us a specific story. While the broader market, led by heavyweights like Nvidia stock and Apple stock, is navigating its own macroeconomic currents, Beyond Meat is trading on purely existential survival mechanics. The selling pressure we are seeing isn't just retail investors capitulating. It represents a structural repricing of the company's credit risk. When you log into your Fidelity trading platform or check the charts on your Robinhood app, you are seeing a ticker that is effectively trading like an option on the company's future existence. The expectation was that by late 2025, the health halo of plant-based meat would have solidified a permanent consumer base. The reality, however, has been a massive consumer rejection of ultra-processed food, forcing Beyond Meat to make drastic cuts that are finally showing up in the numbers today. The headline news that is likely filtering through to Interactive Brokers stock trading terminals is the company's decisive move to suspend and substantially cease operations in China. This is not just a pullback, it is a complete retreat from what was supposed to be their massive growth engine. By severing the China arm, they are admitting that the growth story is over and the survival story has begun. This specific pivot changes the entire thesis for someone using Schwab Intelligent Portfolios or managing their own self-investing strategy. You have to ask yourself, is a smaller, leaner Beyond Meat worth more than a bloated, cash-burning global giant? The market's reaction today, pinning the stock under $1, suggests extreme skepticism. The company reported Q3 2025 revenues of roughly $70.2 million, which is a 13.3% decline year over year. That is a double-digit contraction in a business that was priced for exponential growth. But here is where the analysis gets interesting and where you need to look closer than the average Sophie Invest headline. The gross margin has actually improved slightly due to these brutal cost-cutting measures, moving from negative territory in some previous quarters to a positive, albeit thin, margin. This creates a tension in the stock price. On one hand, the business is shrinking. On the other hand, it is stopping the bleeding. If you are holding Tesla stock, you are used to the idea that a company can burn cash for years before turning a corner. But Tesla had a product that people were lining up to buy. Beyond Meat is facing a demand problem, not just a production problem. The short interest on this stock is another massive factor that you cannot ignore. With over 50 million shares shorted, representing a massive chunk of the float, this equity is a powder keg. If the company announces a successful debt refinancing or a strategic buyout, the rush to cover those shorts could send the price vertical, regardless of the fundamentals. This is a classic scenario discussed in Fidelity wealth management circles as a distressed equity volatility play. It's not investing in the traditional sense, it's speculating on market mechanics. The bearish argument is winning right now, as evidenced by the sub-$1 price, but the crowded nature of that trade means any positive spark causes an explosion. For those of you watching this on Robinhood Crypto or Robinhood Cash Management accounts, you know the psychology of these low-priced stocks. They attract a specific type of liquidity, fast, aggressive, and fickle. Let's take a step back and look at the operational reality. The company burned through over $40 million in cash just this last quarter. When you compare that burn rate to their remaining liquidity, the math becomes scary very quickly. This is why we are seeing such pressure on the stock today. The market is effectively pricing in a capital raise. In the world of online investing, a capital raise for a company with a stock price under $1 is usually toxic. It means massive dilution for existing shareholders. If they issue new shares to raise money, the slice of the pie you hold gets significantly smaller. This is the death spiral financing risk that interactive brokers platform users are likely hedging against right now with options. However, the contrarian take, the one that challenges the consensus, is that the brand value of Beyond Meat still holds significant weight. It's a household name. In the consumer packaged goods sector, that kind of recognition usually finds a buyer. The question is whether the equity holders get wiped out in the process. Now, I want you to pause for a second and engage with this idea. Comment below how many shares of Beyond Meat you currently hold, or if you sold out long ago. Are you holding the bag from the all-time highs, or are you looking at this $0.98 USD price as a lottery ticket entry? I want to know the real sentiment of the retail trader right now, because that sentiment often drives price more than the balance sheet in the short term. Moving deeper into the financials, we have to talk about the health narrative. The biggest headwinds hitting the stock aren't just interest rates, they are cultural. The shift in consumer preference towards whole foods and away from processed alternatives has hammered the industry. Beyond Meat has tried to reformulate, launching IV versions of their burger with avocado oil and cleaner labels. But the market data suggests the consumer hasn't fully bought back in. This connects to the broader online investment themes we see across the board. Just as investors pivoted from growth to value in 2022 and 2023, consumers are pivoting from novelty to staples. Beyond Meat is priced like a premium product, but being treated by the recession-wary shopper as an unnecessary luxury. When inflation hits the grocery aisle, the expensive plant-based burger is the first thing to get cut from the list. This macroeconomic pressure is the invisible hand pushing the stock down to these levels. If you are using Fidelity ETFs or Fidelity mutual funds, you have likely seen your exposure to this sector vanish as fund managers rotated out of speculative food tech years ago. But for the individual brokerage account holder, the temptation to bottom fish is strong. You look at NVIDIA stock trading at massive multiples and think, I missed that boat, so you look for the beaten down assets. But you must understand the difference between a stock that is cheap because it is misunderstood and a stock that is cheap because it is broken. Beyond Meat is currently fighting the broken label. The exit from China is a double-edged sword. It saves money immediately. Stopping the cash bleed is priority number one, but it also caps the upside. Without the massive China market, Beyond Meat becomes a domestic niche player. Does a domestic niche player justify a valuation that can support its massive debt load? That is the billion-dollar question. We also need to discuss the competition. It's not just Impossible Foods anymore, it's traditional meat packers launching their own hybrid products, and it's private label brands undercutting on price. The moat that Beyond Meat thought it had, its proprietary extrusion technology and branding, has proven to be shallower than expected. In the world of investing sites and forums, the discussion has shifted from how big can this get to who will buy the scraps. The technology is impressive, Replicating the fibrous structure of muscle tissue using peas and brown rice is no small feat of engineering. But if the customer perceives it as a chemical slurry rather than a healthier burger, the tech doesn't matter. This perception battle is where the company is currently losing, and it is why the stock is languishing below $1. However, let's look at the contrarian bull case for a moment to ensure we are being objective. If, and this is a big if, the company can stabilize its cash flow by 2026 as they have projected, and if the interest rate environment softens, allowing them to refinance their debt on better terms, the stock at $0.98 USD is mispriced. At this level, the market is pricing in bankruptcy. Any outcome that is not bankruptcy is a win for the stock price. This is the asymmetry that attracts the Robinhood stock trading crowd. You are risking 98 cents to